Hello, everybody. This is Rob Unger from NACHA, the Electronic Payments Association. Welcome to our webinar today called Understanding Card Payment Costs. The webinar today is brought to you by the Payments Help Desk, a service of NACHA's Elevation Services. And we're going to have a really big show for you today here, guys. A couple of housekeeping notes as we begin. First off, just wanted to let everybody know that everyone who registered for the webinar, regardless of whether or not you're able to attend, will within a couple days receive an email. The email will have a link to the recording, and it will have links to the PowerPoint presentation as well as some other resources. This email should be used for your proof of attendance. We get a lot of questions about whether or not we provide a certificate, and at this point we're not providing certificates, so if you're looking for continuing education credits, you can certainly use this follow-up email from GoToWebinar regarding your proof of attendance. And today's presentation is scheduled for 1 hour, 1 o'clock to 2 o'clock Eastern. We've got about 40 minutes of presentation time, and we're reserving a lot of time for your questions. So getting to that, please do feel free to ask questions as they occur to you. On the screen here, you'll see hopefully something that you see on your computer screen as well, which is the control panel. Be sure to click on the questions toggle right there in the lower right-hand corner as you see it to pose a question at any time, and we'll get to those questions at the end once we get to the presentation today. Also, if you want to download a PDF of the presentation today, you can click on the handouts menu and you can download that handout. Okay, today I'm happy to present to you a really big show, and really excited to have Anand Goel from Optimize Payments Consulting lead us in today's discussion about understanding cost payments. Anand, take it away. I'll let you provide any of the highlights here on the introduction, and I'm ready to steer at your behest.
Sounds great. Thank you so much, Rob. So, folks, thank you for making the time to attend today's webinar. And we really want to make this presentation relevant and beneficial for you. So as Rob mentioned, as we go through the slides, if you have any questions that don't get answered, go ahead and put them in the question box, and we're going to try to answer as many as we can at the end of the presentation. And you can download it, this current deck by clicking on that link if you want to take notes. In terms of my background, I've been in the merchant acquiring card processing industry for 14 years. The first 4 were with Elavon, where I managed the pricing and analytics team, and the last 10 years running Optimize Payments Consulting. And so my team and I, we have a perspective on the card processing industry, from being inside the industry as well as being outside, consulting to a lot of large corporates. So next slide. And next slide. So we have a lot to cover today, so let's jump right in. In terms of what I'm going to talk about, I'm going to just give you a couple of bullets about Optimize Payments Consulting. And then I'm going to give you a high-level overview of a card processing transaction in terms of how it flows from your organization to the card processor, and all the costs that are incurred by your organization and what kind of drives those costs. And then I'm going to talk about different pricing structures that are used in the industry. Next, I'm going to talk about effective cost. It's one of the most important metrics that you should be tracking on a regular basis. And then finally, end with some best practices. So next slide.
Anand, did you want to do the poll?
Oh, yes, we have guys, because we have a lot of folks from different backgrounds, it would be really helpful for us to kind of understand where you guys are coming from. So we have 2 questions. This is the first one. What is your annual card processing sales volume per year? So if you guys could quickly fill that in, and then we'll share the results with you. And then we'll have one more question after that.
Okay, responses are flowing in here. I know we got registrations from a number of different organizations on it, so there could be very well be a range of responses here.
Yeah.
Okay, we're going to close the poll, folks. Last chance. All right, we're going to close the poll here and share the results.
So it looks about a third of the participants, 30% less than 5 million, 30% of over 50 million, and then 23% don't accept, and the remainder between 5 and 50 million. Okay, that's good. So we have a smattering of companies of different sizes. So that's great. Now let's jump onto the second poll. Question?
Great. All right, here we go. All right, the next one, let's see, what is your biggest challenge?
So what is your biggest challenge with card payments? And you can select more than one answer.
Okay, the votes are rolling in. All right, I'm going to close this poll in just a second here. Last chance.
So the number one is cost. We have reconciliation as a top two choices. Understandably, cost is going to be a big component. And you guys are attending the right webinar because we're going to be spending majority of our time talking about cost. And I'll also touch on towards the end some of these other areas too. Fantastic. Thank you, Rob. So with those two questions out of the way, let's go to our next slide. In terms of the previous slide, go back to the previous slide. About Optimized Payments, as I mentioned earlier, we're about a 10-year-old company based out of Atlanta, Georgia, and we're purely a consulting firm where we help corporates. We provide them consulting services and analytic services to help them understand and reduce the cost of card payments. And we focus on all industries, primarily in the US and Canada, focusing on Fortune 1000 companies. That's about us, and then now let's go into the presentation. When you think about the flow of a card transaction, whether you're a retailer, e-commerce, you're using a mobile app, all transactions they follow a similar process. I won't go through all the steps, but the high level, if you're a retailer, you're using a point of sale system, you're using a payment terminal. If you're an e-commerce company, you're probably using some sort of a gateway. But in either scenario or both scenarios, a transaction authorization request is going to go through your merchant processor, and then it's going to go to the card networks, which is the step 3. And then the card networks are Visa, MasterCard, Discover, and then Amex. They're going to take those transactions to the card issuer, the bank that originally issued that card, for an authorization request. And that response from the issuer is going to go flow back through the card networks, through your processor, through your gateway or your payment terminal back to you. That process typically, if you're using an IP connection, takes less than 2 seconds. And you can read the individual steps here, but those are some of the key components. And in this process, it's also kind of outlines the major players that are involved in processing a card transaction. And it also kind of highlights who's going to be charging you money as a transaction flows through this ecosystem. So as we go through the presentation, we're going to be talking about processors, card networks, and issuers. So just keep that in the back of your mind. Next slide. When you think about all the money that you pay for card processing, you can divide up all of those fees into 4 big buckets. And if you're a retailer, it might be just 3. And they are in order of magnitude. The biggest one is going to be interchange. So majority of the money you pay for card processing today goes towards interchange, and we'll define each one of these terms in subsequent slides. Number one is interchange. That goes to the issuing bank. Number two is assessments and dues. They go to the card networks, Visa, MasterCard, Discover. Number three is the fees that go to your acquirer or your payment processor. And I'll be using the terms acquirer, merchant processor, payment processor interchangeably, because for the most part, they mean the same thing. And then the fourth component, if it's relevant in your environment, you might have a gateway where you're paying gateway fees. And sometimes gateway services can be provided by a payment processor. So those are the four major components of card processing fees. I'm going to highlight the first three, the three fees that make up 99% of your costs. So first, let's talk about what is interchange and why does it cost so much. So next slide. Let's define what interchange is. Interchange is the price that's set by Visa, MasterCard, Discover for settling a credit card or a debit card transaction. All the interchange that you as merchants pay goes to the bank that issued that particular card. So for example, if you use a Citibank Visa card at a Macy's department store, the interchange rate that's associated with it, in this example, it's Visa CPS Retail, 1.51% plus 10 cents for a $100 transaction that equals $1.61. That entire interchange goes to Citibank because they issue the card. And the biggest thing that interchange pays for is all the benefits that we as consumers get from using our cards. So today, if you're getting cash back, miles, points for using your card, all of those benefits are paid for by the interchange revenue that banks make from whenever you use a card. So interchange pays for our rewards programs. It also pays for the cost of money, because there are many of us who pay off our credit card balances in full at the end of every month. When we do that, we basically had the use of a bank's money for about 25 to 30 days. And we didn't have to pay any interest charges. So, there is a cost to the bank for basically giving you that line of credit. So it pays for the cost of money. It also pays for the bank's internal cost for running rewards programs, and also pays for fraud. And also interchange also, lastly, but most importantly for banks, it generates a tremendous amount of profit for them. And that's why, we as consumers are inundated with credit card offers all the time, trying to get banks trying to get us to use cards to pay for more and more and more things over time. And when you look at the interchange in the United States and you compare it with that of other developed countries, whether you're looking at Canada, Australia, Europe, United States has the highest interchange rates in the developed world. And next slide, and in the next couple of slides, you'll understand why. So one of the questions that we get most often is, why are there so many interchange rates when you look at all the tables from Visa, MasterCard, and Discover kind of combined? When you look at the current interchange tables, there are over 700 unique categories. And there are macro reasons and micro reasons why these interchange tables have grown so much over the last 15 years. The macro considerations are competition amongst the card networks. So card networks are Visa, MasterCard, Discover. What they're always trying to do is trying to grow market share, right? They're trying to get banks to issue cards with their logo, with a Visa logo versus a MasterCard. And for MasterCard, MasterCard logo versus a Visa logo. And one of the ways that they do that is they pitch, unique benefits for consumers carrying cards with their logo. But one of the other things they also pitch is that with our cards have higher interchange rates, and therefore you, the banks, can earn more interchange revenue and can offer richer rewards to your customers if you carry our logo. And now imagine competition amongst the card networks and even amongst banks. What that does is instead of driving down interchange, it actually drives up interchange. If you look at credit interchange, effective credit interchange cost over the last 20 years, it has steadily increased over time. And you probably see this within your own data, which is banks issue more rewards and signature cards today than they did a decade ago. And the reason they do that is because they carry higher interchange rates. And also card networks and issuers, their own strategies. Card issuers, they are trying to get more of their customers to carry rewards cards because they carry annual fees and they also carry higher interchange rates. A third reason why we have so many interchange categories is because of emerging markets. Both the card networks and the card issuers, they're trying to grow usage in the United States. We're pretty much paying for everything with cards, but they're always trying to find new markets where cards could be used. When I was growing up, you couldn't use credit cards at grocery stores, but now it's like majority of their sales are through credit and debit cards. And in the last decade, the issuers and the card networks have made tremendous inroads for small ticket purchases, whether that be parking meters, vending machines, even washaterias where you have washing machines and dryers. Now they take cards. So whether it's small ticket purchases or in emerging markets, like you can use your cards to pay rent payments. You can use your cards to pay utilities and for government fees and taxes and things like that. So every time you have a new vertical that's introduced, a new emerging market, the card networks and issuers introduce new interchange categories as an enticement to those new verticals to accept cards because there are new lower interchange categories. So that just makes the entire tables grow, right? And the fourth big consideration is legislation, and the key one being the Durbin Amendment that was passed as a part of the DFA, Dodd-Frank Act in 2011. So the Durbin Amendment regulates debit interchange rates, and what that did was that created a new set of interchange rates for regulated financial institutions. So with anyone with assets over 10 billion is regulated debit interchange rates. And banks with assets less than 10 billion, they have unregulated debit interchange rates. So that just caused the interchange tables to get bigger and grow, in size. So those are the macro considerations. Some of the micro level, merchant level considerations are, what industry you're in. Even though that there are 700 unique interchange categories, not everyone applies to you as a merchant. Out of that, there may be a subset of 100 that might be relevant in your industry because interchange rates are specific to industries based on what we call merchant category codes. And they're typically set when you sign up with a payment processor. When they look at your business, you're tagged with a 4-digit numeric MCC code, and that's one of the drivers for interchange rates. A second driver is the type of card. Not all Visa cards are the same. You have many Visa products. So a Visa credit card, traditional card, rewards card, signature card, Visa debit card, Visa corporate card. Every one of these products has a different interchange rate. Third micro consideration is the method of entry, swiped versus keyed, or you can say swiped / dipped. So with the EMV, swipe transactions and dip transactions, they have the exact same interchange rates. Fraud liability, chargeback liability, they differ, but in terms of the interchange cost, they're identical for swiped versus dipped transactions. And then key transactions typically have higher interchange rates. And then the fourth category is risk and adherence to compliance standards. So you as merchants do not have influence on most of these variables. The only area where you can influence interchange rates is the very last point, which is adherence to compliance standards. So when you do not comply to the standards that the Visa, MasterCard, Discover have outlined in terms of how you need to get an authorization and a settlement, you pay higher interchange rates, which we call, on the next slide, downgrades. So what is a downgrade? A downgrade is when you don't pay the best available interchange rate for a given transaction. So here are some examples of downgrades, or when you don't follow the rules that are set by the card networks. So one is if you have a keyed transaction or card not present transaction, Visa says you have to do AVS. AVS stands for Address Verification System. So in the authorization request, you have to send the customer's 5-digit zip code in the authorization request. If you do that, you meet the requirements and you pay a keyed or a card not present rate. But if you don't do that, you typically end up paying about 40 basis points more if you don't do AVS. Second example is the card networks require that you get an electronic authorization for every transaction that you settle. So you remember the old, like if your telecom goes down within your environment, if you're a retailer, and you, or let's say you go with that, if your telecom goes down, you basically, your terminal cannot communicate to get an authorization request. So you can't like swipe someone's card or you can't dip someone's card. In the olden days, we had these knuckle busters with these little slips where you would take an imprint of a credit card. Well, that's not an electronic authorization. You would end up paying a higher interchange rate. Another example is, let's say you try to get an electronic authorization, but the authorization is declined, but you still go ahead and settle that transaction anyway. Well, you didn't get a valid electronic auth, therefore you're going to pay a higher interchange rate. So that's one example. The second one is the authorization versus settlement timing. And they vary slightly if you're a retailer versus card not present. Typically, if you're in a retail environment, you have 24 hours between authorization and settlement. Typically, all retailers, they have automated their point of sale systems, so they auto close at the end of a day. If some reason you auto closed, but you weren't able to communicate that file to your payment processor, or you weren't able to settle, then your it would throw off your authorization and settlement timing. If you're in a card not present environment and you ship product, typically you have a week between an authorization and a settlement, if you're shipping product, that is. If you go outside of a week, then you have gone outside of the authorization settlement window for card not present merchants who ship product. You would pay a higher interchange fee. And a third example is your authorization and your settlements amount have to match exactly to the penny. And if they do not, you pay higher fees. The only exceptions are in industries that allow for tips. So restaurants, beauty salons, cab rides that do allow for tips, you have what's called tip tolerances where the auth and the settlement amount do not have to match. And then another big category or area of downgrades is if you, when you accept commercial cards. When I say commercial cards, I mean cards that are typically used by businesses. So they might be business, commercial, corporate fleet cards. And you do not send level 2, level 3 data associated with those transactions, you end up paying higher interchange fees. And recently we wrote an entire article talking about business-to-business card acceptance, level 2 and level 3. And if you guys, if some of you do take business card payments, maybe we can get to some of the questions in the Q&A, but those are some of the biggest reasons why transactions downgrade and merchants don't pay the optimal interchange rates. Next slide. So we talked about interchange. We talked about why there's so many interchange categories and some of the drivers suboptimal interchange categories. That's a lion's share of the cost you pay for card processing. The second biggest component is the fees you pay to the card networks. And here we have a slide that kind of shows the market share of the 4 biggest brands in the U.S., the 4 biggest networks. Each of these networks charge, a series of assessments and dues, and they average roughly 13 basis points and 2 cents per transaction. That's for Visa, MasterCard, and Discover. And they're charged on gross sales. The only sort of caveat is American Express. With most of you, if your American Express sales are over $1 million a year, then you have a direct contract with Amex. So then the slide doesn't really apply to Amex. But only if you have sales less than $1 million, then you're subject to American Express assessments and dues, and you can get your sales authorized and settled by the same vendor or the processor that does Visa, MasterCard, Discover. Next slide. So card networks, Visa, MasterCard, and Discover, they're all publicly traded institutions. They do not get any portion of the interchange revenue. All their revenue comes from assessments and dues, and all these fees are publicly available. But on average, they're going to make up about 10 to 15% of your overall cost of card processing. As I mentioned on the previous slide, the assessments range from 12 basis points to 14 basis points, and then about 2 cents per transaction. Those are averages. There are a number of fees that you may pay in assessments and dues that are based on specific circumstances, and they don't apply all the time. But collectively, with Visa, MasterCard, Discover, there are 30 unique assessments and dues fees that may apply in different instances. So that's the second biggest cost. Next slide. Now let's jump into the last component, the last biggest cost of card processing, which is from your payment processor or merchant acquirer. Merchant acquirers are key. They're a key link between you and the card networks. And another really critical and important role that merchant acquirers and processors do is they do all the KYC, anti-money laundering. They basically vet you as a merchant. When they underwrite you and they process for you, they're basically validating you are a legitimate organization. They have done due diligence on you, and that you're providing a real good or service. And in the event if a merchant ever goes out of business, it's the merchant acquirer who's on the hook for any sort of fraud. So imagine if, I don't know if you guys remember during the financial crisis a couple of years ago, back in 2009, 2009, there were some small airlines that were on the eclipse of going bankrupt. If an airline goes bankrupt, all those sold airline tickets that have people haven't traveled. Well, if the airline goes out of business, all those customers would want their refunds, right? Well, guess who would be on the hook for paying all those refunds? It would be the merchant acquirer. So merchant acquirers are really key in that they basically vouch for you, and they're supposed to do a tremendous amount of due diligence when they bring you onto their system. And that's why you have to provide so much information to them when you go with a new provider. So with that as background, the biggest providers in the United States, here's a listing of top 10. And they're based on the Nielsen report rankings that were published in March. And what they do is they look at the 2016 volume that was processed for bank card sales, signature debit, and PIN debit. And we have a kind of a ranking in terms of market share. And just note, with First Data, it includes all the First Data joint ventures like Wells Fargo, B of A, PNC, and all their bank alliances like Citibank and SunTrust. And then you have all the other providers. And then for these, I would say top 10, you have over 1,000 resellers or ISOs. And basically, they're providing the sales, marketing, and potentially customer service for some of these providers. So if you have an opportunity, I would say you want to be with one of the bigger providers versus a reseller, unless that reseller was providing some unique value that you couldn't get from some of these big providers, like in-language customer support or integration to a payment to an SAP that you couldn't necessarily get by going directly to one of these providers. All right, next slide.
Excuse me, I just want to remind folks that we've gone through a lot of material here. Please do take advantage of the questions queue if you have any questions for Anand, which we'll get to at the end. Sorry, Anand, go ahead.
No, absolutely. So acquiring fees, there's a wide range in acquiring fees. They can make up anywhere from 5 to 20% of your total cost of card processing. And there's lots of, just like there's lots of unique interchange categories, acquirers have lots of varying fees with different names. But the key thing to note is that most of those fees are negotiable. Next slide. And one of the important sort of takeaways is that merchant acquirers, every single one is subject to the same interchange rates that are published by Visa, MasterCard, and Discover. There is not a single processor who has better interchange rates than the next one, right? So with that in mind, with the interchange being uniform for everybody, they do have different pricing structures that they go to market with. And here are the three most, the most predominant ones. Number one is interchange pass-through, which we recommend for merchants because it's the most transparent, because you know what's interchange, what's assessments and dues, versus what's acquiring fees or processing fees. The second pricing methodology is called tiered, where you get, a couple of tiers. Typically, you see 3 tiers: qualified, mid-qualified, non-qualified. And what processors do is they bucket, a group of interchange rates and they deem them as qualified, deem others as mid-qualified, deem the rest as non-qualified. And with each tier, each subsequent tier, they basically add a higher markup. So markups with tiered pricing tend to be different versus interchange pass-through, where you have a uniform markup across all interchange categories. And then the last bucket is bundled. And when you think of bundled, think of like Square-like pricing, where you pay 2.75% for all swiped or dipped transactions, or PayPal on the web, where you're paying a 2.95 for all web PayPal transactions. And what they're doing there is they're bundling all the interchange categories, all the assessments and dues, and all the acquiring fees into a single rate. Bundled pricing makes sense if you're a small merchant, if you're like a micro merchant, if you're doing thousands of dollars a month in card sales, because it provides simplicity, predictability, and there's value to that. And there are many industries with smaller merchants where that makes perfect sense. So those are the main methodologies. So we talked about the 3 biggest components: interchange, card network fees, acquiring fees. Now let's look into now let's try to put all that together. And we can put all that together by calculating your effective cost. At the very beginning of the presentation in my outline, I mentioned, if there was a single metric that you should track on a monthly basis, it would be this. It's effective cost. And it's simply all of your fees divided by your net sales. So, and it's all your card processing fees. Here, you don't care about what the fee is called. You don't care if it's interchange, assessments of dues, or acquiring fees. You can get to that level of granularity if you have the data. But for right now, let's just focus at a high level, and we can always drill down. All your card processing fees, if you have more than one provider, You might have one provider for Visa, MasterCard, Discover. You might have a direct relationship with Amex. So you can bring in Amex fees as well. So all of your fees divided by your net sales, so your gross sales minus refunds. And when I say sales, net sales, you want to take your Visa, MasterCard, Discover sales as well as your Amex sales. And you divide them and you get a percentage value. So if your percentage value is 2.13, basically that it's a weighted average cost. What that tells you is for every $100 you take in, you're paying out $2.13 in card processing fees. Now, if you have the data labeled correctly, what's interchange, what's assessments and dues, what's acquiring fees, you can take that 2.13 and you can break it down further into the three individual components. Now, having said that, one thing to keep in mind is there are some providers that bill 1 month in arrears. Most notably, it's First Data. They do bill 1 month in arrears, so just be mindful of that when you are taking sales, let's say for August, that you want to make sure you get the fees for August as well, because on the August statement, you'll see the August sales, but there's two sections of fees. There's the charged fees in August, but those charged fees are from the month of July, and then they're pending fees. You want to take the pending fees because those will be charged in September. It's crazy how First Data does it, but that's the way to do it. So just kind of keep that in mind if you do use First Data. So those are the 3 steps to calculating your effective cost. Now we have 2 additional poll questions for you guys, and just to get a sense of if you guys understand your effective cost and how much time you guys spend in looking at your card data. So the first question is going to be.
So we're going to ask about the effective cost rate.
Yep.
Here we go.
So the first question is, now we talked about effective cost. If some of you track your data or your effective cost, go ahead and fill in one of the boxes here. And the question is, what is your overall effective cost of processing credit debit cards? And you get 5 choices: less than 2%, 2 to 2.5%, 2.5 to 3, greater than 3, or you don't know. Not sure.
Anand, do you find most people? I was wondering, do you find most people know their effective costs or not?
The number is smaller than I would expect. I would say you would think that 80–90% of corporates would know it, but I think what they might know is they might know the absolute dollar value because they know on their P&L they're spending $100,000 in fees or $1 million in fees, but they may not necessarily know in relationship to their card sales.
Gotcha. Okay.
Yeah.
Well, let's see what our audience says. Last chance to vote, folks. I'm going to close the poll and share the results here.
So we have 15% to say it's about less than 2%, 21% 2 to 2.5, 13% to say it's 2.5 to 3%. 2% say it's over 3%, and 50% say don't know, unsure. So Rob, this kind of goes to my point where a lot of the folks that are in the 50% bucket, they may know the absolute fees they're paying, but they may not have done the calculation to say, oh, what are my net card sales, and therefore, what's my effective cost? So now that you guys know, you should go back sometime this week and calculate your effective cost. So let's go to the next slide.
You want the next slide or the next poll question?
Oh, I'm sorry, I forgot. We have one more poll. My apologies.
Yeah.
So here, we just want to get a sense of how much time are you spending on a monthly basis analyzing card fee or card payment data? Is it 0 hours because you're not doing it, less than 5 hours a month, 5 to 10 hours, 10 to 20 hours, or more than 20 hours per month? And this could be collectively as a team or a group. So when I think of you, I'm thinking about the organization.
What's your expectation on this one, Anand?
I think it'll mirror to some degree the last poll question where 50% said they didn't know. And if they didn't know that, then you might see a high percentage of people that say 0 hours because they're not spending time analyzing the data, or less than 5 hours. I think majority of them will be in the first two options.
Interesting. I think you're going to be right here, Anand. So last chance to vote. I'm going to close the poll. And here are the results.
Yeah. So as we expected. So that is good that folks are, let's see, 70% are spending some amount of time analyzing data. So that's actually a really good number.
Good.
And my sense is that the corporates who have higher card sales and therefore card fees are probably spending more time than the corporates who don't have as much card sales, right? Because it's not a big of a concern.
Right.
So let's go to the next slide. Let's try to bring this effective cost discussion, give you a perspective. So you can divide your organizations up into, either your retail or your internet or not face-to-face, or you might have a combination of both, where you have retail operations as well as, card not present operations. And what we try to do here is, based on our experience, over the last 10 years in consulting, is try to create this grid for you to show you that if you can calculate your effective cost, what kind of savings opportunity there might be given what, if you're retail or card not present, and what your effective rate is. So this kind of a grid basically says if you're a retailer and your effective cost is less than 1.80%, there's a low to a medium chance in terms of there's material savings. But if your effective cost is greater than 1.8% in your retail environment, there's probably a high probability that there's savings opportunities, for you. And then if you're an internet e-commerce merchant, if your overall effective cost is less than 1.8%, there's probably a low chance of savings opportunity. However, if it's over 1.8, there's a medium to high chance. Now, these are for typical average merchants that are doing over 5 million in card sales a year. There are a couple of caveats. One is, if you are a merchant with a really low ticket size, this grid is not going to apply to you, because your effective cost is going to be, probably over 3%, because there's some per item fees that drive up your effective cost, and there's no way around it. Because if your ticket size is, if you're like a QSR, a quick service restaurant, or your parking meter, or your washateria, your effective cost will be over 3%, and there may not be a lot you could do, but it's still worth investigating. Another caveat is, if you're a retailer, like if you're a grocer, groceries, there's some industries that have really low interchange rates, and the biggest one is grocery stores. If you're a grocer, most grocers in the United States today have their effective cost that's below 1%. So this grid wouldn't apply to you. So there are a couple of industries that don't apply when you're looking at this grid, really low ticket sizes, specialized industries like grocery stores, or utilities. Power, electric, waste, because the card industry has set up, low customized interchange rates for those industries. So you can use this as a guide that there may be some savings opportunities on both the interchange side and the acquiring fee side. All right, on our next slide, we're going to just give you some best practices, and we're going to jump right into questions. So guys, I wanted to give you a lot of time for Q&A, so I'm going to kind of quickly run through these. basically, you can negotiate your processing fees. If you have multiple sales channels and you have multiple different processors, try to consolidate your volume so you can leverage your combined volume for better merchant acquiring fees. And also, it reduces PCI compliance overhead if you're dealing with one company versus multiple companies. Next slide. So you may want to, if you go back one slide, oh, did that skip? There we go. Here are some additional recommendations. Verify your merchant category code with your processor. Make sure it's correct. Sometimes incorrect MCC codes can drive incorrect interchange rates. Review your statements and look at how many transactions downgrade. And here we covered the top 3 reasons for downgrades. If you're in a retail environment, you may want to look at host capture. It gets a bit technical. If any of you guys want to know, we can talk about it in our Q&A session. And if you're in a retail environment or card not present environment, make sure you automate your systems so that it automatically asks for the customer's billing zip code if it's a keyed in or transaction in a retail environment. So it's not something that the cashier can, bypass. If you're in a card not present environment, always capture customer's billing zip code. Next slide. And then, if you are in a retail environment, look at least cost routing. And if you take commercial cards, look at enabling the ability to send level 2, level 3 data. Look at our last article that we wrote about level 2, level 3, and making a business case to see if sending level 2, level 3 data makes sense for your organization. Because if you take a significant amount of commercial cards, the savings could add up. We had a client that did $380 million in commercial card volume, and they saved $6 million a year by sending level 2, level 3 data. The last one, dynamic international routing, that's for 98% of merchants, it doesn't make sense. But if you're a multinational merchant who has a global presence, it's something that you should look into. And our last slide is with your payment processors, request interchange pass-through pricing, do mini RFPs near the end of your contract term, just to get a sense of pricing in the marketplace, and try to consolidate your volume with one provider, unless you have unique circumstances, or you're doing billions in volume and you need a secondary processor for redundancy purposes. So with that, that's all my slides. Let's go to Q&A.
Sure, thanks, Anand. Covered a lot of material here, and we've got a number of questions. So just kind of taking them in order here. First question, are interchange fees regulated?
For credit cards, no, in the United States. For debit card, yes, if the card is issued by a regulated financial institution, and that is defined by any bank with assets greater than 10 billion. So cards issued by the big banks like Chase, Wells Fargo, the debit cards issued by those organizations, those banks are regulated, whereas debit cards issued by your community bank or your credit union are not regulated.
Gotcha. Okay. Do virtual one-time use cards get higher or downgraded rates, interchange rates?
No. So virtual use one-time cards, they are big in business-to-business payments, and they would be a commercial card, and they're eligible for level 1, level 2, level 3 rates. So if you are accepting virtual cards and you are able to send level 2, level 3 data, you will pay a lower fee than if you do not send level 2, level 3 data.
Mm-hmm. Right. So getting back to your best practice about if you do accept a number of commercial cards, certainly look at level 2, level 3 data.
Absolutely.
What's the difference between pinless debit networks and signature debit networks?
All right. So if you guys take out a debit card out of your wallet or your purse, and you look at the front of the card, I'm going to take out mine. Mine's from Wells Fargo. Mine on the front has a Visa on it, and it says it's a debit card, and then on the back it'll have a one of the other logos like NICE, Pulse. Basically, every debit card issued in the United States today, almost every card, it's like 90+% of the debit cards issued in the U.S. have the ability to go on two different rails. There's a rail on the front, so on the front it says Visa. If it goes on the Visa rail, or it might have a MasterCard bug, that's called signature debit. So typically, if you go to a retailer and you run it over the Visa rail, the MasterCard rail, you have to sign for it, and it's called signature debit. If you're at a grocery store and you swipe your debit card or you dip your debit card and you punch in your 4-digit PIN number, that transaction can go over on the what they call PIN debit rails. So the PIN debit networks in the United States are Interlink, Maestro, Pulse, NICE, Star. Traditionally, you had to put in your 4-digit PIN in order to, when you were at a grocery store and you wanted to use your debit card as a PIN debit card, because it offers more security. But what a lot of the PIN debit networks like Interlink, Star, NICE, what they're doing now is, in a retail environment, if a transaction is less than $50, they're allowing those transactions to flow over their network without requiring a PIN, just to offer faster checkout. So it gets a bit complex, but basically the key takeaway is every debit card has the ability to go over two sets of rails, the rail in the front and the rail in the back. The rail in the front is always either Visa or MasterCard, and the rail in the back is one of what we call EFT networks, electronic funds transfer networks, Pulse, NICE, Star, Interlink. And if you use that same card online, today, for the most part, there's a few exceptions, for the most part, you cannot put in a PIN number. So when you take your debit card online, it's always on the rail on the front of the card, which is Visa or MasterCard.
Mm-hmm. Gotcha. Okay. Anna, we have a couple questions about level 2, level 3. One is, what are some examples of level 2 and level 3? And another, a person went to their payment processor and was told that if they submitted different data for level 2, level 3, they'd get a better rate, but they're having a hard time understanding what that data is.
Okay. So when we talk about level 2, level 3, we're specifically talking about commercial cards being used with your organization. So commercial cards are business, corporate, purchasing, fleet cards. Level 2 simply means, in addition to your basic data that's sent in an authorization and a settlement file, like the transaction date, the transaction amount, the merchant's name, level 2 means you're sending sales tax information in, sales tax and a customer code. Level 3 means you're sending in the basic information, which is transaction date, transaction amount, merchant name. Level 2 data, which is sales tax and a customer code, along with line item detail, like the individual SKUs that were purchased. So let me illustrate that with an example. If you were to go to a office supply store like a Staples and you buy pens, 10 pens and 20 pencils, in an ideal scenario, Staples in their settlement file will communicate to their processor two line items that say this person bought unit quantity 10, unit price was 99 cents, extended price was $9.99, and the item description was pens, and then the same sort of information for the next product that was purchased. What the issuers do with all that information is they take all the level 2, level 3 information, they supply it back to the corporate, the company that's the card user, right? That's using their commercial card, and they can bring it into their ERP systems and analyze that data to better manage their vendors, to better manage sales tax reporting, things like that. And if you look at the second article that we wrote in conjunction with Rob and Natcha, second blog, it details out very specifically the individual line items that you need to send for level 2 and for level 3.
Yeah, there's a nice chart on them that you supplied in there. It has all the data elements and what's level 1, level 2, level 3, so very illustrative. Anand, does PCI impact interchange rate?
So PCI has zero impact on interchange rates. Obviously, it has tremendous, and I would say far more important impacts on data security, and you want to do everything you can inside your organizations to be PCI compliant, because these fees are inconsequential when compared to data security and making sure that all the information you're collecting from your customers, your card information, that's secure, and that your customers can trust you to keep that information secure. So even though that they're not related, PCI, you can be not PCI compliant, it has no impact on interchange fees. But my message to you is that, in terms of priorities, generally the IT part of the organization looks at PCI compliance, and the treasury side looks at costs. You want to make sure that you're doing everything in that's possible to be PCI compliant.
Great. Okay, we're almost out of time, but because effective cost is such an important metric, we do have a couple related questions there, Anand. One is, what is considered a good rate for your effective cost? And the other was just a little confusion. So the lower the effective cost percentage, the better. So maybe it might be worth just touching on effective cost again.
Yeah, absolutely. So Rob, I know we're coming to the top of the hour. I'm available for another 5 to 10 minutes if you are, and if any of the folks who are on the webinar, if they want to stay on, just to get these questions answered, because I know I want to make sure that we kind of provide as much information as possible.
Yeah, let's do that, folks. So if you have to drop off, certainly drop off. You will be getting a link to the recording. So if you've been listening the whole time and you just couldn't hear the last part, you can skip ahead and listen to the end here. But as Anand said, we're perfectly willing to stay on the line here and answer these questions. So go ahead. Did you want me to repeat the question about effective cost, or do you recall?
No, I got it. So in terms of what is a good effective cost, there's not a single answer, because there's so many circumstances that can impact effective cost, your industry, your ticket size. So there's not a single best effective cost. And, we try to provide some semblance with the table a couple of slides ago, that if you're in a retail environment, if you're in a card not present environment, here are some ranges to kind of keep in mind. So I would use that. And I did provide some caveats, like it's not necessarily relevant if you're a small ticket or if you are in one of these emerging markets. Okay, having said that, yes, the lower the effective cost, the better it is, because the way to think of effective cost is, for every $100 you take in, what are you paying out in fees? What is your number? Is it 1.5% versus 2.5% versus 3.5%? So the more you're paying out, the higher the number, the more of your revenue you guys are spending on fees. And is that what you want to be doing? Because every dollar you save in card processing fees goes to your bottom line on your P&L. So, I think traditionally corporates have thought of card processing like a utility, that there's not a whole lot we can do to manipulate our costs. But the reality is, there are several variables, levers that are available for you to influence. And, we're trying to provide some context on some areas to point you guys towards, to look at those levers. And if you guys need help, feel free to contact us. We can provide you some additional insights. But yes, the lower the effective cost, the better it is for you.
Yep, so you want that lower rate, and as you said, Anand, you've provided a number of strategies to help reduce that rate.
Yep.
Question here, you said interchange is the same for swiped or dipped, but fraud charges are different. What did that mean, the fraud part?
I see. So if you are a retailer and you have two customers that come to you, customer one, they swipe their card. Let's assume everything else is the same. The dollar amount and everything is the same. Customer number two comes to you and they dip their card, and it's a Visa card, and it's everything else the same. The interchange cost for those two transactions are going to be identical. Your processing fees are going to be identical. However, your fraud liability is going to be different. So if let's say both of those customers, they contest the transaction, meaning they're saying, oh, it was a fraudulent transaction, I didn't really authorize it. Because transaction number one was swiped, and you've already passed the deadline by which you have to be EMV ready. Basically, the card network say you have to, if someone comes to you with an EMV card, you got to process it as an EMV transaction. If you do not, you're liable for fraud. So let's say both of those customers say it was a fraudulent transaction. You will lose the first case because you were supposed to process that as a EMV transaction, but you didn't. You processed it as a swipe transaction, but you will win the second case because you correctly processed the transaction. An EMV card is an EMV transaction. The fraud liability in that instance goes to the issuer, whereas the fraud liability in the first instance goes to you, the merchant.
Gotcha. Okay, Anand, there's a few questions here about merchants and how to really absorb or how to handle these increasing costs related to cards. So one question is, they're thinking about taking credit cards because the customers want to, but they're going to be charged a certain percentage. Is there any way to get around these fees and take a credit card payment? The related question is surcharging a practical approach to offset interchange fees? And another related question is, can a merchant pass through card costs to the customer in any situation? So some merchants grappling here with, how can we pass these fees along or charge the customer or otherwise avoid them but still take credit cards?
Yeah. So here are a couple of things that you want to think about when you think about surcharging or figuring out a way to recoup your card processing costs. Number one is, do you want to accept cards for competitiveness reasons? Because if you're a retailer, you got to accept cards. I mean, there's no way around it. But if you don't accept cards and you're in a B2B environment and a lot of your corporate clients or some of your clients are really requesting you take cards, if it enhances your relationship with your customers, that might be a reason to do it. You might do it for competitiveness reasons. You might do it because a customer might leave you if you don't take cards, everything else being equal, right? So you may decide to take cards, and then, yes, you can pass along those. So there are two things you should do. One is, if you're going to pay fees, try to minimize those fees by utilizing some of the strategies we outlined in this webinar. Try to pay the lowest fees as you can. And then on top of that, you may want to think about passing a surcharge for your customers who use cards. So there are some rules that go around how you communicate that surcharge, what that surcharge is. So you may decide that it's a percentage-based or a flat dollar value. There are opportunities where you can charge them a percentage rate. You may want to charge them, let's say, 2.5% for any card any payment that's made with a card. However, if they want to avoid the 2.5%, that they can pay with other payment means like check or ACH or wire. So those are some possibilities. Just a couple of things to note is that there are 10 states in the United States that prohibit surcharging. So as long as you're not in your customers are not in those 10 states, then you're okay. And then as long as you don't get significant backlash from your customers and for surcharging. but I have seen some B2B in certain instances where companies have accepted cards payments simultaneously implementing surcharging to recoup some of their costs.
Gotcha. Okay, let's see. As a follow-up to the virtual card questions, is anyone using card with two signature networks? Is there any way for the merchant to select the lower cost network in the virtual environment?
No, none whatsoever. Typically, the way virtual cards work is you have a corporate, a large corporate that works with a specific bank issuer, and that bank, whoever the bank is, Chase, Wells Fargo, B of A, SunTrust, they will put that corporate on a particular card program, a virtual card program. It might be a Visa, it might be a MasterCard, where they dynamically generate numbers, one-time use card numbers, and they may have some parameters around it. That here's a one-time card number that is valid for this day for this amount, So there's a lot of controls in place.
Right.
To date, now, I've only seen single branded card, network branded cards. I mean, there may be some players in the marketplace that are experimenting with two, but keep in mind what the motivation is for the issuer and the corporate. The issuer is trying to generate interchange revenue for themselves, right? So the average interchange revenue on whether it's a virtual card or a corporate card or a purchasing card is around 2.5%. Out of that interchange revenue that the issuer is generating, they're sharing a good portion of that back with the corporate who's using that virtual card. They're not trying to get you to a lower interchange rate. They're trying to maximize their interchange revenue. So they're hoping you don't send level 3 data. They're hoping you send the bare minimum requirements. So you end up paying the highest interchange rate. So the issuer, the bank, generates the greatest amount of interchange revenue. So the issuer, as well as the corporate who's using the virtual card, their motivation isn't to reduce your interchange costs. Their motivation is to increase them.
Right. Okay. And sort of along those lines, a question's asked, is it possible to qualify for level 3 data if you don't for level 2? Example, a transaction that is exempt from sales tax and doesn't qualify for level 2.
Yes, absolutely. Yes, you can do that.
Okay. Let's see. Getting back to how merchants are handling the increasing costs for receivables as card payments are increasing, the question is, are most merchants building the cost into the pricing you pay if you're using a card for business payments?
Pretty much. I mean, that's the reality today, is that it just becomes a cost of doing business, and it invariably ends up affecting the pricing that you charge in the marketplace. And it kind of goes along with surcharging too. You may decide, if you have a business client that's buying, goods and services from you, and they want to put it on a corporate card or a virtual card. Well, you may, knowing that, you may want to adjust your pricing to kind of bake in that cost. So clearly, many companies, look at that as a cost of doing business, which invariably gets baked into the price in the marketplace.
Okay. 2 more questions, Anand. One, how big is AVS, address verification, downgrade impact? Does it apply only to Visa transactions?
Yes, AVS is specific for Visa, but typically the best practice is when you're going to implement a strategy, you want to implement it for everyone because it's a good thing to do. Even though there's not an economic impact on the MasterCard side, we recommend that you do it for all card brands. And it's about, it's about 45 basis points if you don't do AVS on the Visa side.
Right. Okay, final question, Anand. Is there a list of card types that has interchange levels which shows what they can be reduced to with interchange optimization?
Yeah, let's see. Yes, there is. We've developed our own tables, and generally there may be some providers. I would say the first thing would be I would ask your payment processor for such a table because they should be providing something like that to you. But if you have difficulty or you can't get a hold of one, reach out to us, reach out to me, and depending on who your provider is, we may have a table. Because we don't have tables for really small processors, but maybe for some of the bigger ones, we could share something.
Great. Okay, Anand, that wraps it up. Wow, you covered a lot of information. Thank you so much for joining us and leading this presentation. We did cover the questions, and as I mentioned to folks, within a couple days you'll be getting an email that has both a link to the recording as well as a link to the PowerPoint presentation and some additional resources. As Anand mentioned, if you have any questions about the presentation day, you're certainly welcome to contact Anand directly or myself, and we'll get you in touch with Anand. Thank you, everybody. Thank you, Anand. Thank you, Monica.
Thank you, Rob. Thanks for putting this together. Thank you, everyone.